Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Hello, and welcome to Live Squawk's Market Talk, our weekly review on Friday, the 17th of October, 2025. This is where we break down the key stories of the week gone and implications for the markets. We'll also take a look at the week ahead and try and give you a heads up as to what you should be looking out for. It's been a busy week without actually being that busy in terms of US data. US government still shut down, but we'll give you as much of a perspective as we can about what to look out for in the week ahead on the US front and the data front particularly. We'll have going on in the G7. Right, before we get into any of that though, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that, I'll introduce my market expert this week, who is Chris Studley, our resident author of the Live Squawk Commodity Corner. Hey, Chris, how you doing?
Hey, Harry. Great to be here. Thanks.
Excellent. Right, well, let's get straight into it then and take a quick look and just review, really, what we saw last week. Obviously, the headline story on the geopolitical front was the Israel-Palestine agreement, or ceasefire, if you like, for the time being, and hopefully that will last, and we'll continue to see a rebuilding of relationships there. Your perspective quickly on that in terms of what it's done for the market, if anything at all, before we get on to the rest of the content.
Sure. There's already been some chatter about them breaking the ceasefire, some attacks in Lebanon, if I remember correctly. So we'll have to see if this does hold. Obviously that's a very delicate situation. So if anything, the only commodity or market that I know of that would be affected by the Israel-Palestine situation would be crude oil. If the tensions do keep cooling, that should keep crude oil at bay to a small degree, but it's not uber bearish in my view either. So as for Russia, Ukraine, obviously he's trying to set things up a little bit better between them and hopefully get this war ended. That's obviously going to have huge implications on crude oil flows, and perhaps even wheat as well. So, we'll just have to kind of see what new headlines transpire from that.
Yeah, I know that they're trying to set up a summit in Budapest, Hungary, to try and see if they can advance talks on really generally trying to bring this to an end. So, again, we'll wait and see how that turns out. All right, moving on then, we'll keep with the US. The US-China trade dispute, things are still very much up in the air on that front. We saw President Trump last weekend really try and damp down some of the initial worries over, again, that 100% tariff increase on China trade goods. And then just say, look, there's plenty of time before the 1st November when the implementation was supposed to come in for the two sides to talk. And he's really tried to play that down a touch. We've had Besant during the week as well, just really call out some Chinese officials for not really playing ball, and that's roiled the markets to a degree. I don't think it's been the main factor behind some of the risk off that we've seen during the week, but it has contributed, I guess, to what we have seen so far. What are your views on where that's likely to go, or just generally what you think the impact is on the markets you look at?
Sure. This will impact practically every market under the sun. We've seen how volatile the stock market can be off of any Trump true social post. So, this is by no means are we out of the woods. And, even just this morning, he did an interview, I believe it was on Fox News, where he said that the tariff rates are unsustainable. But interestingly, he didn't say that they're going away. So, he's supposedly going to meet with President Xi at the end of the month. Hopefully something positive will come out of that. But, again, I do not want to be a betting man in that regard. And, this is especially important for soybean farmers because, China has not booked any soybeans from the U.S. since May, and nothing from the current crop year that's being harvested right now. So, this has definitely got a lot of major economic implications for the entire United States. So I mean, there's no pocket that is unaffected by this, for lack of better phrasing.
Yeah, this is still one of those fluid situations that we're likely to carry on seeing play out over the weeks up until that meeting with China's Xi. Keeping on the market volatility front, then we've seen this week the start of earnings season. In itself, always a busy time for market players on the equity front. But also we're seeing really some issues, or supposed issues with the regional banks and worries about liquidity there. And it's led to people looking at the Fed facilities at the moment, their short-term funding facilities, to see if we get any kind of spike in utilization. What are your views on that? Has it been something? Do you think this is a bit of a storm in a teacup at the moment? We have had a couple of the regional banks report, and they haven't shown any liquidity issues or any credit issues for that matter. I think credit issues were one that people were focusing on in across bank earnings this week.
Yeah, there are a couple regional banks that did report earnings over the past few days, and it sounds like some of these are taking some decent, actually credit losses, trying to write down loans and things like that. So my guess is that, there's going to be more of this, just from kind of the data and tea leaves that I read. There's also, this was a headline from Bloomberg earlier this morning that auto loan delinquencies are starting to spike again. And I've been hearing that about credit card loans as well. So, I think that issue is going to keep popping up as we see more and more bank earnings coming out, not necessarily of the huge bulge bracket banks, but definitely your regional banks. As for volatility, this goes back into, what we just said a moment ago about U.S. and China. I think we're setting up for quite a bit of volatility, over the next several weeks as we kind of keep diving into more and more earnings. And just, this is a volatile time of year anyways. So.
Okay, so I guess next then we want to turn to to the UK and Europe. And we had labour data out of the UK on Tuesday, followed by GDP data on the Thursday. Labour data was fairly, benign for the markets really, but showing that the job situation at the moment now is maybe starting to be a bit impacted a little bit more by the budget, the preemption of the budget that we have coming up, and really what we've seen previously from the UK Treasury Department and Rachel Reeves' comments, I think in the past really have just unnerved many out there. But on the GDP front, again, the same can be said for that really. We got an insipid 0.1% growth rate coming through on the August print, 0.3% on the 3 months to August really. Services and construction sideways, and industrial production really just weighing a touch on activity. And with the budget coming up there and everything else, no one's really expecting, experts aren't really expecting the Bank of England to move in November. Just a quick note here from analysts following the data. we heard from the Deutsche Bank's chief UK economist, said that both services and construction hit a pre-budget funk, likely dampening discretionary household and business spending. We also heard from Ruth Gregory, deputy chief UK economist at Capital Economics, saying that weak overseas demand continued to weigh on growth, and noted that the 0.7% month-over-month rebound in manufacturing output only partly offsets July's fall, leaving the 3-month rate flat. We got trade deficit widened as exports started to falter. Data was out as well. According to the ONS, the trading goods deficit widened by some 3 billion to 58.4 billion, while the trade in services surplus increased by 1.3 billion to 53.2 billion. This is from Deutsche Bank's Raja again. Says, we expect some turbulence to continue as we approach year end. Indeed, the UK economy has yet to see the full ramifications of the US trade war. We got German ZEW numbers out as well this week, the monthly survey of investor sentiment, and the expectations indicator saw a 2-point gain below estimates of 41.1. It came in at 39.3, with the Eurozone outlook and current conditions both slightly weaker than last month as well. Again, in the report, German investors remained moderately upbeat about the country's medium-term prospects. The think tank saying that its October expectations indicator there was on the rise, as I said, to 39.3, which undershot the forecast, with current conditions gauge meanwhile continuing to deteriorate, falling to -80 from -76.4. That was weaker than the -74.2 estimate. The ZEW president, Achim Wambach, said that despite persistent global uncertainties and lack of clarity over this state investment program, experts still expect an upturn in the medium term. But again, this is one to watch. The modest improvement in the ZEW index was consistent with last week's Centix survey, which pointed to a stabilizing but still fragile economy. Okay, so the China CPI reading, that was out this week as well. Any thoughts on that, Chris?
Most Chinese CPI and inflation data has been lower than expected, and just keeps decreasing. They've been in a pretty bad deflationary environment for the better part of 2 to 3 years now, and it just doesn't seem to be improving at all. So we'll have to see if they have any more stimulus packages or what have you to finally get the inflation back in play. So
let's turn to the week ahead, and there is hope that we're going to get some US data out. So there was a note that came out from the BLS, the Bureau of Labour Statistics, that said it would release the September CPI report this coming week. I think it's this coming Friday. I think they're looking to report. So some good news on that front, that we start to see a bit more clarity, I guess, on the current situation. Although it's going to be a bit foggy for the next couple of months. We haven't, number one, it's backed up now, and number two, we haven't got a government, a working functional government in the US at the moment. So collation of data is still going to be a bit of an issue, isn't it?
Yeah. Just kind of the early read that I saw is they're expecting CPI to go up by 0.3% month over month. That's slightly lower than the previous one of 0.04. So, and this could impact Fed policy. Like you said, we're kind of starving for data right now. So, and if I can just make one other brief point about Fed policy, they have that meeting the week after next. There's been a lot of Fed speakers out this week, jawboning about interest rates. Most people, or most of them, are thinking that they're going to lower it by 25 basis points again. Now all of these Fed speakers are going to be in a blackout for all of next week. So again, that just adds to the slightly adds to the uncertainty again. So just wanted to put that out there.
Yeah, absolutely. It's great that we're getting a bit of data out there, just to give us some sort of insight into where inflation. I don't think anyone would be surprised with the numbers that we do get from the inflation report, because again, we were gearing up to to receive them, as I said, this week anyway, and most of the work had been done on as I say, collection and collating of that data. So yeah, it'll be interesting anyway to see how markets react to that. But again, on that front, because we've had so much data missing out the US, it's brought these survey data is now far more relevant for the trader and investor out there at the moment, because it's the only way they can glean really any information about the state of the US economy for the time being anyway. We will have the PMI readings out for the US, both flash readings for both services and manufacturing out of US and across G7 anyway. So it'll be interesting to see what that is. A quick look at, I think we might have a note here from HSBC on the number. They say the broader set of flash PMIs will be interesting to note, particularly on the manufacturing side, to see if firms are yet to feel any of the effects of August tariff hikes by the US. In recent months, the global manufacturing PMI data have held firm, but there are some pockets of price pressures emerging outside of the US too, which are worth keeping an eye on. Anything to add on that in terms of, would you now pay more attention or closer attention to the PMI readings as they appear?
Sure. I think trade will take slightly more heed to these private numbers, no matter what they are. But all of that information gets disseminated pretty darn quickly. So will it have a long-term effect? Probably not. So.
Okay, cool. Elsewhere, we've got mainland China GDP for Q3 on Monday, and at the same time, we'll see their 1-year loan prime rate for October. I think they're looking for unchanged on that figure as well out of China. We saw, as you said, you mentioned the inflation data that came out last week. Any concerns you have on China at the moment? And obviously, again, as a commodity guy, the knock-on effect to what you see?
Sure. Nothing really off the top of my head. I know for mainland GDP, they don't give really any estimates on that, or forecast, I should say. The previous one was 5.2%. We'll have to see if it kind of aligns with that. If it does, that kind of obviously means that things are status quo. But I cannot get very, very bullish if I can give an opinion, if that's okay. I'm still kind of moderately neutral to bearish on the Chinese GDP and economy in general, as we've seen in aluminum prices and copper prices and what have you. So, and also crude oil as well. So.
Yeah, fair enough. I mean, again, HSBC note here says, we look for GDP growth to slow to 4.7% annually, reflecting the leg down in the pace of consumer spending and the cooling of manufacturing investment in recent months. They expect investment weakness to continue, with fixed asset investment to slow to just 0.1% year over year to date, with the property sector playing a key role here. Consumer demand is cooling a bit too, and we expect retail sales growth to be 3.2% annually, as new stimulus measures are yet to bite in terms of lifting demand. As we move towards the end of this episode, I want to make sure people are aware we have UK inflation data out as well. That's looking to come in maybe double the Bank of England's target of 2%, really, as we see, again, sticky, persistent inflation pressures in the UK. Probably as one of the reasons why we're not seeing more dovish Bank of England at the moment, because they're mindful of what we're seeing on the inflation front, and also, according to some experts, ahead of the budget, they're not looking to preempt any kind of impact that may have on the monetary policy and the rate setting path. So it's going to be steady as you go, I think, for the Bank of England. But again, UK CPI next week will be an important one to watch, as will Japan's CPI. We had comments from Japan officials. I think Ueda spoke as well. It says he needs more data, or the Bank of Japan's governing council need more data before deciding on moving on policy. Again, the odds were ahead of the new new LDP leader being brought into office, Takaichi, that we were likely to see an October hike, but that's now less likely, especially after comments made by some members of the rate setting committee and by UADA, who says more data is likely needed before making a move. So Japan's CPI will be an important important gauge really for the Japanese and for the markets as well. I mentioned PMIs. Obviously, we got Eurozone flash PMIs as well during the week, as well as the UK figures also. So that's pretty much it. Again, things to watch, I think, moving forward, the short-term rates. I know that a few traders this week have been watching that with interest, really, just to see if we start to see any blips in demand for short-term funds. Just going back over something I saw the other day that says we have to keep an eye on money flow that comes in. Chris, do you have anything?
Yeah, I was just going to add in one thing that actually ties in 3 different countries, if you don't mind. The U.S. We kind of bailed out Argentina earlier this week with a $20 billion facility, and supposedly there's another $20 billion on the way. What's kind of interesting is nobody knows the exact terms of this, and this does kind of throw a clinker or a weirdness into our relationship with China, because I know U.S. farmers are furious about this deal because Brazil and Argentina are our top 2 competitors for soybean exports to China. And as I mentioned earlier, China has not purchased anything from the U.S. In several months. So, again, that just adds more to the evolving political situation. So,
yeah, indeed it does. Just a quick note on this funding issue at the moment, and this is a note from the FT. It says banks tap Fed lending facility in sign of short-term market strains. Institutions tapped up some $15 billion of short-term lending facility over the last 2 days in a sign of liquidity pressures in the repo market that could drive the Fed to stop shrinking its balance sheet. Banks borrowed $6.75 billion on Wednesday and $8.35 billion on Thursday from the Fed's standing repo facility, the largest amount borrowed over a 2-day period since COVID-19 pandemic. Again, we did see market jitters yesterday on the back of some of the fears around this short-term funding issue at the moment, as I mentioned earlier, and it's definitely one that we keep an eye on. I've got a note here from Sam Cutler, one of our guests on the show as well, who's been looking at this as he probably should as a fund manager. But his opinion was, let me get this up. It's been a week for sure, with a lot of people scared yesterday on a possible SVB repeat. If you remember early in the year, we had worries over liquidity for some of these regional banks, US regional banks. Private equity is a bubble for sure, but one that will take a long time to work its way through. Credit spreads should be higher in his opinion. But he says the real stress he's seeing is in the plumbing. There's been good funding pressure this week. So in his view, he sees reserves drainage are largely done for now. Trouble line is when the reserves are below some 10% of GDP. And says effective quantitative tightening is only roughly 15 billion a month. So again, it's not playing it down, but saying there's a long way to go before we start seeing this really sort of bear its teeth on the markets in any kind of concerning way. So interesting times and just multifaceted in terms of areas of concern for some out there who think that maybe we're in some kind of near-term bubble anyway. I mean, that word's been freely used of late, hasn't it, Chris, in terms of explaining this AI move?
Yep, exactly. And we've seen multiple bubbles, in metals, in AI equities, quantum computing, and this is global too. There's been some chatter that certain AI names out of China are also in a bubble as well. So definitely interesting to see.
Okay, well, cool. On that note then, I look forward to the week ahead. Listen, Chris, thank you very much for taking the time to join me on today's episode.
No problem. No problem. My pleasure.
If you've missed any of the start of today's episode, you can listen back on X or YouTube, or find us on podcast platforms such as Spotify, Apple Music, or Amazon Music, as well as other places. Thank you all for listening. Have a great weekend, and we'll see you here again next week.
Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.